There are two catches to this simple idea. The first is that common stocks with good records and apparently good prospects sell at correspondingly high prices. The investor may be right in his judgment of their prospects and still not fare particularly well, merely because he has paid in full and perhaps overpaid for the expected prosperity. The second is that his judgment as to the future may prove wrong. Fresh. Unusually rapid growth cannot keep up forever. When a company has already registered a brilliant expansion, its very increase in size makes a repetition of its achievement more difficult. At some point, the growth curve flattens out, and in many cases, it turns downward. It is obvious that if one comes himself to a few chosen instances based on hindsight, he could demonstrate that fortunes can readily be either made or lost in the growth stock field. How can one judge fairly of the overall results obtainable here? We think that reasonably sound conclusions can be drawn from a study of the results achieved by the investment funds specializing in the growth stock approach. The authoritative manual entitled Investment Companies, published annually by Arthur Weisenberger and Company, members of the New York Stock Exchange, computes the annual performance of some 120 such growth funds over a period of years. Of these, 45 have records covering 10 years or more. The average overall gain for these companies, unweighted for size of fund, works out at 108% for the decade 1961 to 1970, compared with 105% for the S&P Composite and 83% for the DJIA. In the 2 years 1969 and 1970, the majority of the 126 growth funds did worse than either index. Similar results were found in our earlier studies. The implication here is that no outstanding rewards came from diversified investment in growth companies as compared with that in common stocks generally.